get
still
funded
make
now.
progress on inflation because policy is still meaningfully restrictive.
Victoria.
Hi, Victoria Guida with Politico. I just wanted to make sure I understood what you were saying at the beginning about inflation. Are you saying that progress on core PCE counts as progress on inflation even if headline inflation ticks up? And then also, since that's what's projected in the SEP, I was wondering what accounts for that? Why do you all see core PCE going down and potentially headline inflation ticking up?
So, and as I imagine the goal overall is headline inflation because that's what people experience. People don't experience core inflation; they experience inflation, and that includes food and energy costs. So that's the overall goal. But as we know, headline inflation contains energy and food, and those prices can fluctuate for reasons that are not related to tightness in the economy and therefore are not really good predictors of future inflation. So it turns out that core inflation is a better predictor of overall inflation than overall inflation is. So we look at core inflation because it's a better measure of what future inflation is likely to be because it's a better measure of what inflation pressures exist. So it's complicated, but ultimately our goal is headline, not core. So your second question was what?
Why do you all see core going down but headline potentially ticking up?
So headline can be affected. You're talking about next year.
Mm-hmm.
Yeah, so headline can be affected by energy prices and food prices. So that there will be things in the headline forecast that are to do with forecasts of energy prices, whereas core will be, if you look at core going out a full year, then it'll be much more driven by things like tightness in the economy. So that's why the two can go in different directions. Headline has been lower, as you know, most of this year. That's because energy prices have been coming down, which is a great thing for people, but energy prices will come down and they will go up, and it won't really be telling us anything about how tight the economy is and how future inflation will perform.
Do geopolitical risks factor in at all to how you're thinking about energy prices?
So we monitor geopolitical risks really quickly, but really carefully rather. But I would say so far those risks nothing has come out of those risks that has really been important for the United States economy. The single thing that you would look to is the price of oil, given that we're talking about the Middle East and Ukraine, but that is a good summary statistic for the kind of thing that could go wrong with global turmoil. But the price of oil has been coming down, and because of global supply conditions. So the U.S. is not feeling really the effects of geopolitical turmoil. But we are certainly at a time of elevated geopolitical turmoil, and it remains a risk.
Kelly.
Thanks, Chair Powell. Kelly O'Grady from CBS News. I want to go back to something that you said a minute ago, that wage growth is outpacing inflation now. It wasn't the case for some time, of course. It's partly why Americans haven't felt much relief in their wallets from prices yet. But with inflation ticking up, how worried are you the progress in closing that gap could go away?
Yeah, so inflation, again, we don't overreact to a couple of months of higher readings or a couple of months of lower readings. And what we had was we had 4 months of really nice readings, and then September and October were higher, but then November is much lower. So I don't really think the public is experiencing that as a surprising upside risk to inflation. I think inflation is much lower. What the public is feeling, and they're right about it, is that prices are just, the price level went up because of the past inflation. It is going to take some time for real wages to recover over a period of years in which your real compensation is growing. And in other words, your compensation is growing meaningfully faster than inflation. That's exactly the kind of economy we have now. And we just want to hold on to it. That process will probably take some years, but that's what's going on right now. And I don't think that a couple of months of higher inflation really signal that anything of the nature you're suggesting.
And just one follow-up. Let's look more long-term. You previously predicted hitting the 2% inflation target in 2026. It's now been pushed out to 2027. You said you're focused on enabling further progress on inflation. That's not necessarily progress in the right direction. Are you confident that target isn't going to move further out?
We're talking about when you're projecting the economy, 3 years out, 2 years out, you're talking about high uncertainty, very high uncertainty. We really, at that point, that's not possible to confidently predict where the economy is going to be in 3 years. So what we're doing is we're looking at what's happening now. We're kind of projecting that the same kinds of things are happening. So we keep a strong labor market. Housing services inflation comes down, goods inflation settles down, and non-market services return to their prior level. All of those things should happen over time, and those pieces come together. There's every reason to think that they will. The timing of it is highly uncertain. But you're not wrong though that it's been a bit frustrating because while we've made progress, it has been slower than we had hoped. Nonetheless, we're still on track, and I think if 2 years ago you'd said we were at 4.2% unemployment and 2.8% inflation, people would say, "I'll take that." I mean, that's a pretty good interim place to be. Job's not done, but I think we're feeling good about where we are and where we're headed.
Go to Nancy for the last question.
Hi, Chair Powell, Nancy Marshall-Genzer from Marketplace. You said a couple times inflation has been moving sideways. Appears to be settling in around, 2.5%. Do you think the Fed is just going to have to settle for that and accept that you're not going to get to your 2% target?
No, we're not going to settle for that. I think we certainly have every intention and expectations that we'll get inflation back sustainably to 2%. That is, and I am confident we will achieve that. It has taken longer, but you have to be, we are making progress. We have made a great deal of progress, and we'll continue to do so and get back to 2% inflation. That's what we owe the public, and we're committed to achieving it.
In that case, can you rule out a rate hike next year?
You don't rule things completely in or out in this world. That doesn't appear to be a likely outcome. I think we're at 4.3%. That's meaningfully restrictive, and I think it's a well-calibrated rate for us to continue to make progress on inflation while keeping a strong labor market. So, thank you very much.
That right there, arguably not the Federal Reserve's finest hour. After reducing interest rates by 25 basis points straight out of the gate in that news conference, asked an obvious question. Why do this when you're expecting inflation to remain above target? The chairman acknowledging today was a closer call, that we've cut interest rates by 100 basis points across 3 meetings. The recalibration phase is over. We're in a new phase. Things are foggier, they're darker, you move more slowly. Well, this was the price reaction to that in the market. Equities slammed, down 1.5% on the S&P, on the NASDAQ down by more than 2. The small caps, some outperformance on the small caps going into the decision, real underperformance coming out of it. The small caps down by 2.8% in the bond market. Big move at the front end of the curve. Yields up across the curve, 2s, 10s and 30s on a 2-year up by more than 10 to 434.82. And off the back of that, in foreign exchange, as you might expect, the dollar stronger against everything in G10, ripping up EM. Euro dollar breaking down through 104 and threatening to do the same to 103. Euro dollar right now at 103.64. We all had questions about the forecasts. Why have you bumped it up on inflation? Why are you projecting higher inflation than you were projecting back in September? Why have you reduced the number of interest rate cuts from 4 to 2 in the median dot for the dot plot in 2025? Is it about the data, or is it about Donald Trump? Take a listen to the chairman of the Federal Reserve.
Some people did take a very preliminary step and start to incorporate highly conditional estimates of economic effects of policies into their forecast at this meeting, and said so in the meeting. Some people said they didn't do so, and some people didn't say whether they did or not. So we have people making a bunch of different approaches to that. But some did identify policy uncertainty as one of the reasons for their writing down more uncertainty around inflation.
Compare and contrast that to what you heard from the chairman back on November 7th. We don't guess, we don't assume, we don't speculate. December 18th, some of us guess, some of us assume, and Lisa, apparently, some of us speculate.
The we is doing a lot of heavy lifting at a time where clearly he's reflecting a splintering committee that is dealing with a whole host of different outcomes and potentially political leanings. And I just want to go here. This is going to be viewed through a political lens, inevitably. It already was threatening to do so. Now there are some people who are incorporating highly conditional estimates. I wish that we had learned more about what those estimates looked like and whether they all were inflationary or whether some of them were to slower growth.
Neil Dutter wanted to jump onto the program. We can bring him into the program right now. Neil Dutter of Renmac. Neil, is this Federal Reserve on a collision course with the incoming administration?
I mean, it certainly feels like they're tempting fate. Powell's talking about, he goes through a litany of indicators talking about how the labor markets are cooling, and then he, in the same sentence, basically talks about how they're dialing back rate cuts. So I think that's a problem. And, I think the optimistic take around this is by making the forecast adjustments that they've made, they're actually, in some respects, lowering the bar for additional action, early next year. So, like 2.5% on core inflation, I mean, that's a reasonably high number. And, given what we know about rental inflation, that's probably going to slow down. Given what we know about, consumer goods, if you look at things like freight rates, it's probable that consumer durable goods prices moderate, over the next couple of months, just as the new administration's coming into office. So, I think they're signaling a pause, but it's also important to remember that by March, the forecast might look a little bit different, and they may have to cut again.
Neil, you were my economist of the year 2 years ago. You were optimistic when few were. Now you've switched, flat out switched. There's no other way to put it. How off is Atlanta GDP now at 3.1%? Does Powell know something we don't know, and those visible present numbers are just flat out wrong?
I never think, I don't think the Fed really has an economic forecasting edge of any meaningful degree. Tom, the Fed doesn't have a GDP mandate, so it's interesting to see how much Powell was talking up gross domestic product, private final, domestic sales. I thought that was pretty interesting, quite revealing, actually, because that was sort of a way for him to avoid the questions around the labor market. And we know that duration of unemployment, as an example, has gone up by 2 to 3 weeks over the last couple of months. Leaving that aside, you're right. I am more cautious. I remember 2 years ago, around this time, the consensus was conditioned for, basically everyone was penciling in recession, and all I did was point out the fact that the labor markets were fine and housing stocks were moving up and to the right. Fast forward to today, it's literally the opposite situation. Everyone is sanguine on growth. It's very difficult to talk about recession. No one really wants to hear it. And at the same time, we know that the labor markets are slowing by Powell's own admission, okay? And just pull up a chart of home building stocks.
Well, meanwhile, Neil, I just want to point out the fact that other people are taking a different tack than you are. As you say, you're contrarian, thinking that there's more weakness in the market. Peter Scheer saying this. He doesn't think it's necessarily political. He said this is a Fed that is worried that inflation isn't coming down fast enough, and while it might play in the back of their minds, they aren't responding to fiscal potential policy. On the margins, some are, but he's saying in general they are not. Why do you disagree so fundamentally with that?
Just go through the document. Look at the balance of risk to the inflation forecast. It's a dramatic increase in the number of participants that see the risk to headline and core inflation as skewed to the upside. So, they can say whatever it is they want, but based on the data, it's very difficult to justify the distribution of risk that you see in the projections. And how are the risks to inflation going up at a time when labor is cooling and wages are slowing? We know that recruiting intensity is down. We know that quits rates have changed that much, and Powell even said that based on the inputs changed that much, and Powell even said that based on the inputs from core CPI and producer prices, you'll probably get a pretty weak reading on core PCE inflation when that data are released on Friday. And the big story, again, out of the inflation data over the last week has been the normalization of housing rental inflation. So I think, to me, this is it feels a little bit like they're prejudging potential policy outcomes.
EM currencies right now getting hammered. Neil, I don't expect a collar. I don't expect a tie, but maybe just a jacket next time. Neil, maybe a jacket, for some post-Fed show commentary.
I think it's okay.
Get me back in the studio. Get me back in the studio. I'll put on, my Gucci for you.
There we go. I'll make that happen, Neil. I'll make it happen soon. Hey, Neil, appreciate it, sir. Enjoy the holidays. Neil Dutta there.
You could have shown up in a Christmas sweater. I mean,
next time.
The white T-shirt was better.
I've got one with Roberta Baggio on the back.
Do you really?
Yeah, number 10.
Oh, but do you
Nice
have
Christmas
like little things
sweater.
hanging off of it, like the little
legit one.
tassels?
No, not with jingle bells going on it.
And like lights?
It says
lights, no
Lisa,
glitter.
it says Monday. I mean, it says Monday.
Monday, definitely, when I'm not here. Sarah House of Wells Fargo joins us now for more. Sarah, these forecasts, some controversy around them. Neil Dutta making the argument that he believes that underpinning that shift in inflation higher, in those dots, for the dots coming down from 4 cuts to 2, he believes there's a real Trump effect in the forecast. Sarah, is it the data or is it the incoming president?
I think it's a little bit of both, John. So I think you've seen, certainly there's been a little bit stronger momentum in terms of the inflation numbers. That's why you got the upward revisions to the Q4 numbers here for this year. But I think when you look at just the magnitude of the change as well as the balance of risks, we heard Powell say that at least some participants included some assumptions around policy and some didn't say if they were. So I think there is a little bit of recentering the risks around the forecast within these projections.
Sarah, when you do all the math at Wells Fargo, as you do with Jay Bryson, when you sum it up, what are you going to watch forward to the next Fed meeting? I mean, Neil Dutta just said GDP is not part of the mandate. Do we watch the jobs report? Do we look at inflation? I mean, what really matters in the guesstimate forward into late January?
Yeah, it's jobs and inflation. So I think after today's meeting, it's a little bit more on inflation. So I think that's one of the big takeaways is we're seeing that emphasis shift back towards more of a focus on inflation after I think the labor market took more of the spotlight in the late summers. We had a couple-week jobs report, unemployment rate going up pretty quickly there. But I think today's message was they have less conviction about that downward path of inflation. So I think the next few reports, especially getting through the first quarter where there's a lot of questions about residual seasonality. So do we actually see enough of a slowdown where you start to see that 12-month trend, which Powell talked about so much in today's press conference? Do you see that begin to come back down? But they are still looking at the labor market, and I think that did feature in not just today's cut, but also still what is an easing bias, where they do have a couple more rate cuts penciled in for next year because, as you heard Powell also talk about in the press conference, they're still seeing that labor market cool.
Right now we're seeing markets respond pretty strongly to this, and people forecasting that maybe, at least this is the implication, this could potentially make a more difficult circumstance, particularly for smaller companies. From your vantage point, on the margins, if this is a Fed that sees itself in a dark room full of furniture or in a foggy land that's moving more slowly, that on the margins is going to slow your expectations, Sarah, for growth next year?
A little bit. I mean, we're still looking for 3 rate cuts next year, so not terribly different from what the Fed has penciled in. But of course, when they come, could have implications for what happens with financial conditions over the coming months. So I think when we look at the inflation picture, the rate picture, I think overall we're not seeing a meaningful dialing back of policy in the months ahead to the same extent that we were over the past 4 months, where you still have the real rates, closer to 1.5%. So not much change there, and I think that is still likely to be a headwind, particularly in some sectors, like Neil was talking about home builders. So I think there's still certainly some pressure in some of those more rate-sensitive sectors of the economy that are going to feel it a little bit more if the Fed's not going to be cutting quite as much or quite as fast as what they were thinking a few months ago.
The next 12 months is going to be quite a ride. Sarah, thank you. Appreciate your time. Sarah House of Wells Fargo. This is the Fed Decides, a Bloomberg Surveillance Special, live on Bloomberg TV and on Bloomberg Radio. If you are just joining us, figures. A 25 basis point reduction from the Federal Reserve about an hour and 35 minutes ago, followed up by quite a news conference with the chairman, Jay Powell. Lots of questions about the forecast. They revised their forecast for inflation a bit higher for 2025 and beyond, and they took down their projection for interest rate reductions for next year, down from 4 in the median dot, down to 2. Off the back of that, there were some questions about why cut interest rates at all. The chairman called it a close call, said the recalibration phase was behind us. We're in a new phase where we have to move more slowly. Off the back of that, equities just getting absolutely smoked right now. We're down by more than 2% on the S&P 500, down by close to 4 on the Russell 2000. Some severe, significant underperformance on the small caps. If you check out the bond market, we'll just take a quick slice of it. The 2-year, the yield higher at the front end by double digits. The 2-year yield pushing higher, up by around about 10 basis points on my screen at the moment. Call it 11 now to 435. Let's cross over to Mike McKee, who was in the room in the news conference. Mike, your big takeaway walking out of that room.
Well, a number of interesting things in the news conference, including the chairman talking about some members of the committee pricing in some possible effects from the new Trump administration fiscal policies. But the biggest takeaway that I had is that the Fed, including the chairman, are less confident. He wouldn't say he's not confident anymore, but they are less confident about the path of inflation. He basically said it's come down, so we think it's going to keep going down. But it's not like we were seeing in the summertime, where they were very convinced that inflation was on the right track and headed to 2%. So that's really going to inform their decisions as they go forward. The other thing that I take away from this, John, is interesting, is we need to rename this show, because you call it The Fed Decides, but I would add the words, the market disagrees. If you look at the forecasts now in the markets, there is only one cut fully priced in for next year. So we're going to have this tug of war back and forth between the markets and the Fed, it seems, ongoing from here.
That tension continues. Mike, appreciate your time, sir. Great work as always. Joining us now is Jeff Rosenberg of BlackRock. Jeff, I want your first thoughts. I asked the question to Bob Michael at JP Morgan Asset Management, and I said to him going into the news conference, are you more or less confident embracing risk, given what you've just learned from the Federal Reserve? And Jeff, I want to ask that question of you. After that, are you more or less confident embracing risk into 2025?
Well, you can see, Jonathan, this is a surprise to markets. And so one of the things the markets had hoped for was a Fed that was very much leaning towards easy financial conditions, focusing more on the labor side than on the inflation side. And that was pretty supportive to financial conditions and taking risks. So you see the market reactions that you just talked about, not what markets were expecting. And so certainly that's a little bit less favorable environment for risk-taking, because you have a Fed that has really kind of surprised me. I think it surprised the market here in saying, hey, we're more worried or as worried about the inflation side now than we were about the labor markets. And that means we're not going to be as quick to cut. And it's the cut in the policy and the favoring of easy financial conditions that was so supportive to taking risk.
Jeff, the reviews are coming in. That was one of them. Here's some others. Steve Chiverone, worst Powell performance since 21. They overreacted to labor market data in September. And now they are overreacting to inflation data. Krishna Mamani, probably the worst presser so far of his tenure, seems the support for this cut was quite spotty, but they went ahead with it anyway. Jeff, do you agree with that?
Yeah, a lot of the sentiments in there are about just how much the Fed, when they stopped forecasting and became data dependent, the problem is they're dependent on, like, as much as he said they're not trying to be, it feels like they're dependent on the last few data releases. And so, yes, going into September, it was all about labor markets. Now it seems it's all about inflation. I think one of the earlier guests said, and I would agree with this, this is not going to be a great forecast for where the Fed's future forecasts have been, because they've been just so whipped around by short-term movements in data, and that certainly is kind of frustrating. And Jonathan, to your earlier question, it makes risk-taking a bit tougher, because the Fed signaling and what we're going to get out of the Fed is just that much more uncertain.
Jeff Rosenberg, Alan Meltzer at your Carnegie Mellon, Carl Bruner up at Rochester had a shadow open market committee, which the first rule was stability, stability. I don't see stability in EM p.m. I don't see stability. Granted, it's a different story in generic China 10-year. They're going to open here in 3 or 4 hours. Is BlackRock internationally concerned about the Asia opening here? Call it 7 p.m. our time?
Neil mentioned it in his comments about the impact. The Fed sets monetary policy based on domestic U.S. conditions, but the impact on the rest of the world is as important, particularly when it flows back into the United States. And how is the channel for that flowing back? It's through the potential of tightening of financial conditions. I think the tightening in financial conditions from the dollar increase is going to be much more front and center in emerging markets. What Powell talked about is the exceptionalism. What no one really talked about was what is the source of that exceptionalism? What is the source of that exceptionalism? Partly, it's this incredible technology, AI, wealth creation story that is feeding into positive animal spirits. It's feeding directly into consumption through the wealth effect. And so that creates a little bit of a buffer around the U.S. economy, around some of the blowback issues you raise in terms of currency opens and Asia. So I think, we keep an eye on it, but so far it's really this much bigger story about American exceptionalism, which has a kernel, a really important point of that, about this incredible wealth creation we're seeing coming out of technology.
Jeff, I'm pleased that Tom brought this up. The move we're seeing on the screen, the foreign exchange screen on the Bloomberg terminal, really lighting up. We've got a 3% move on the Brazilian currency year to date. We're talking about a move of 23% on the Brazilian currency, 21 on the Argentine peso. We're looking at something like 17% on the Mexican peso. Jeff, as I look around the world beyond EM, not just to Europe, but including Asia and China specifically, China's looking at a disinflationary bust potentially. The chart of the yields, government bond yields in China, just lower, 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 and rolling over into year end. Jeff, how much divergence do you expect for the US versus the rest of the world in 25?
Yeah, we're really exiting. We talked about exiting the phase of monetary policy. We're also exiting this phase of kind of harmonized macroeconomic implications for inflation that was then feeding into harmonization for central bank policies. And so as kind of the reasons that Powell talked about for that decline in inflation without kicking up unemployment rate, it was really about the restoration of supply chains and the post-COVID impact. That was a global impact. That's now starting to dissipate. And what's coming in the aftermath of that are a lot more of the idiosyncratic country-specific fundamentals driving those economies' performance, the currency. You mentioned a bunch of different countries there, from Brazil to Argentina to China. That's really all about domestic economic policies, economic performance that is driving. And so that's really a market environment of divergences rather than convergences. And so that's really affecting the investment outlook, is particularly, for investing between the markets in what I call the cross-section. That's actually a better investment environment. It takes out kind of the directional call, is the dollar going up, is the dollar going down. And you have a lot more opportunities within that global cross-section of investing, both in currencies, FX, curves. It actually creates a better environment in some sense for alpha creation, because divergences create more alpha opportunity.
Jeff, you've said a number of times that because of the increase in uncertainty at the Federal Reserve, an increase in uncertainty as to the path of their policy, that it makes you less inclined to take risk on the margins. Which risk in particular looks most vulnerable to you or less attractive as a result of increasing uncertainty on the Fed?
Yeah, and if I could, I want to pair that to my last answer, because that's the directional call, right? So is the Fed easing financial conditions, raising the value of prices, makes risk taking more supportive? Then that's really talking about risk taking in the beta sense, in the directional space. So where are you more vulnerable? Just to your beta exposure to directional rates, beta exposure to your directional equities. But the divergences question earlier about the impact, thinking about globally, that actually makes risk-taking better in the alpha and the cross-sectional space. So it's about portfolio construction, and it's about how much am I putting risk on in terms of directional space, that's really where the Fed today, that you want to be taking down. The flip side is in the alpha space, in the cross-section, it's actually a better environment. That's where you want to be adding risk into the portfolio.
Hey, Jeff, appreciate your time, sir. Jeff Rosenberg of BlackRock. Enjoy the holidays. Remaining the team will take you through the close in just a moment. Tesla's one to watch going into the close, down 10% at the moment. In this session, have to sort of acknowledge that we're up still about 20-something% this month alone. A couple of things to note here, Lisa. The year so far, Q1, inflation head fake. Q3, labor market head fake. Q4, this Fed looking just a little bit lost.
And honestly, the market is responding to being a little bit lost by selling off in a dramatic fashion.
I'm speechless. I think it's going to be interesting, and particularly I'm watching FX into the Japan Open.
Could not agree more. This dollar is a whole lot stronger. Just how much oxygen is left up here? Your equity market's down at session lows with negative 2.9% from New York. Thank you for choosing Bloomberg.
It's 3:45 on Wall Street. We do check markets all day long here at Bloomberg. Steep losses for U.S. stocks. Bond yields climbed after the Fed lowered rates by a quarter point as expected, but reduced its forecast for cuts in 2025. Bloomberg's gauge of the dollar rose to its highest level since November of 2022. Right to the numbers, because right now we are looking at a 2.7% drop in the S&P 500 index, down 161 points. The Dow is down 1,042. That is a drop of 2.4%. NASDAQ particularly hard hit, down 3.4%. The NASDAQ Composite Index now down 685 points. The 10-year yield, 4.49%. The 2-year, 4.34%. Gold down 2.2%, now $25.89 the ounce. And a retreat for crude, down 0.1%, $69.99 a barrel. And Bitcoin now down 5.5% at $100,715. Here's Fed Chair Jay Powell at the news conference.
We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. To that end, today, the Federal Open Market Committee decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by a 0.25 percentage point.
And we'll have more on the Fed and, of course, the market reaction from Bloomberg Intelligence Chief U.S. Interest Rate Strategist Ira Jersey. So again, recapping on the equity numbers, S&P now down by 2.7%. The Dow is down 2.5%. The NASDAQ Composite Index down 3.5%, with the 10-year right now 4.49%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenivek on Bloomberg Radio.
And a very good afternoon, everybody. This Fed Decision Day, Wednesday, December 18th, 2024, the last Fed decision of 2024. Carol Masser along with Tim Stenivek live on Bloomberg Radio, on YouTube, and of course, Bloomberg Originals. And I got to say, that hawkish cut by the Federal Reserve, safe to say we got that.
We did get it, and look at the way that markets are reacting as a result. We're going to talk about yields with Ira Jersey in just a few minutes. I do want to take us through some equities. We just heard it from Charlie, but the S&P 500 down 2.5%. The NASDAQ Composite down 3%. I'm looking right now at the S&P 500, Carol. Tesla shares, they were down as much as 11%, now down 8%.
I'm just going to say the S&P 500 down the most since early August. You've got the NASDAQ 100 down the most at one point since October of 2022. And then, of course, yields. Charlie walking you through it. You got that 2-year note right now at 4.33, looking at the longer end of the yield curve, the 10-year at 4.49. We're going to talk about all of this. Definitely a reset, definitely a new narrative, but we do wonder kind of where we go or continue to go from here.
Hey, the Russell 2000 is down.
Small cap's getting smacked.
But it's down to before Election Day.
Yeah.
It's down to Monday, November 4th levels.
Yeah. Really getting, right?
It's given up all the gains since the election.
All right, so we're going to talk about all of this. We're also going to get some insight on the rate environment from Frank Sorrentino. He's Chairman and CEO at Connect One Bancorp on the lending environment, the banking environment, housing. They play into that in a big way, and also on that Fed decision. And then we've got a great guest on the tech and AI world.
Yeah, looking forward to that. We're going to hear from Salesforce's Mark Benioff. He also weighs in on the president-elect as Time Magazine's Person of the Year.
All right, all that and more over the next hour or so. First up, though, with the entire Bloomberg News and Economics and Rates team, they have been analyzing and writing all about the Fed decision. If you have any questions about the decision and Jay Powell commentary, how this impacts you, what might be coming in 2025, well, tune into a new live Q&A audio experience on Bloomberg.com. If you do, you'll hear directly from the top reporters here at Bloomberg on the Fed, on the economy, U.S. rates. They're also going to take your questions, too.
Yeah, they're coming in at 4:30 p.m. Eastern on Bloomberg.com. Just to explain this a little more, I got to do one of these when Bitcoin hit 100,000.
Yeah.
Really cool because you can have people listening in real time on the Bloomberg terminal and at Bloomberg.com, and also submitting questions via text
So
at that
really
exact same
interactive
time.
and back and
Super
forth.
interactive, like a conversation with people.
And I'm guessing you have a few questions. I know we do, and that's why we want to get to our roundtable. As we mentioned earlier, that hawkish cut by the Fed, as expected, Fed officials lowering their benchmark interest rate for a third consecutive time, reined in the number of cuts they expect in 2025, signaling greater caution over how quickly they can continue reducing borrowing costs. Here's Fed Chair Jay Powell earlier at today's press conference.
I think that the slower pace of cuts for next year really reflects both the higher inflation readings we've had this year and the expectation that inflation will be higher. You saw in the SEP that risks and uncertainty around inflation we see as higher. Nonetheless, we see ourselves as still on track to continue to cut.
Okay, that, of course, is Fed Chair Jay Powell at today's press conference. Let's get into the Fed decision. Michael Rosen is with us. He's Chief Investment Officer at Angelus Wealth Management. They've got more than $40 billion in assets under advisement and $6.4 billion in assets under management. Michael joining us from sunny and warm Santa Monica, California. Kind of different here. It's warm here, but it's rainy. And here in our Bloomberg Interactive Brokers studio is Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist. Ira, I want to start with you. That hawkish rate cut that we were expecting, safe to say we got it.
Yeah, we got it, but the market clearly wasn't fully priced for it,
yeah.
right?
Yeah.
Because otherwise, we wouldn't be selling off 10 basis points in 10-year yields.
These are big moves.
Yeah, these aren't massively large in recent times, but they're at the same time, if we were fully priced for it, we wouldn't certainly be seeing a 10 basis point move. Where we do see things, and we were talking about this before we went on air, is you look at the pricing for what the Fed's terminal rate is going to be, and we're now pricing only for about another 30-ish basis points, 35 basis points of interest rate cuts next year.
So a little bit more than one move?
Exactly. So not very much. So that suggests that the market still thinks that, and the market does overshoot sometimes, right? But at the same time, the market's now thinking, hey, maybe the Fed is seeing what we're seeing, and that's that the economy's okay, and they're only going to cut one more time, maybe in March, and then they'll be done.
So, Ira, what specifically, in your view, did traders hear today from Fed Chair Jay Powell that caused them to say, wait a second, we're not going to get as many cuts, apart from the summary of economic projections, but we're the terminal rate could be just shy of,
Well, he said that they can move cautiously, like that was actually in the prepared remarks, right? So there's a difference, right? There's the prepared remarks, which are something that, they obviously prepare beforehand.
And we see those right at 2.
Yeah, and you get it, you get it at 2:30, right? So he reads them at 2:30, and then we get the
Those
actual
7-8 minutes of remarks he makes before the
Correct.
Q&A.
And it's basically the statement that you get at 2 o'clock expanded, right?
Okay.
So it gives you more detail of what's in, what they were talking about, what they were thinking, and the like. So that's important because that's like the whole committee's view. Then when you start to get into the Q&A, that's much more Jay Powell, right? And sometimes he's talking about for the committee, and sometimes he's talking maybe a little bit more.
Sometimes he's talking about some people.
Yeah, well, exactly.
Which he referenced, which I thought was interesting.
Correct. And we did have a dissent today, right? So we did have a dissent.
A new member.
A hawkish dissent. New member. Newish. This was the first time for anyway.
Yeah.
I wouldn't worry about that.
I know we're making a lot out of it.
but
we got Ira here to keep us in line.
So
Master, not exactly.
I think that person took the sword basically for probably 2 or 3 other people who also didn't want to cut today, right? Because a lot of times what happens at the Fed, and if you talk to former Fed, Fed governors and Fed presidents, they'll tell you one person dissenting probably means it's really 2 to 4, or don't like it, but they kind of go along with it anyway, just so it doesn't seem like the whole committee's out of whack.
Michael Rosen, come on in on this. Forgive us, we're just kind of digging down with Ira here, but is this a market with the selling that we're seeing? Do you, rethink the outlook here in terms of equity positions, or do you say, hey, some of those names that were getting a little expensive, valuations high, it's actually a buying opportunity? What's your thinking on this?
Well, Carol, good to be with you. I actually think Ira has the right point. I think the market was priced to be more bullish, perhaps, than actually it turned out to be. And we knew we would have a hawkish cut in rates, but again, I think the market maybe was just a little bit too euphoric coming into this, and that's why maybe we're seeing the sell-off. And you're seeing it in the areas that are much more interest rate sensitive, like real estate and consumer discretionary, for example.
So do you buy on this? Are you saying that these are opportunities? Do you say, well, wait a minute, this is a bit of a reset, and so maybe a different environment for equities going forward?
Yeah, I really don't think it's a reset. I think actually the bond market's been behind the curve, not the equity market. The economy is strong. Wages are up, incomes are up, profits are at record levels, and profits are really what drive equity markets over time. So as long as profits are holding in, and they are, with a strong economy, we just saw an ease that happened today. Every indication suggests to me that profits will remain on an upward trajectory, and that is still bullish for equities. I think I would focus on areas that are generating the profits, and those are the big tech companies, the big platform companies that generate tremendous amounts of cash and profits. And those have been the leaders, and I think those will continue to be the leaders as long as those profits remain strong. Areas that are more interest rate sensitive are going to be disappointed. With the economy strong, with inflation that has come down but not nearly enough, and in fact is probably on the rise at this point, interest rates are going to have to move higher. So anything interest rate sensitive is going to be facing a headwind.
All right, so unfortunately, I've got about a minute left here, so saving 30, 40 seconds for you, Ira. So what's kind of, I don't know, like, how do you think about, do we all just pack up and just wait until 2025, or what's your next focal point here?
Well, I think, 4.5%, 4.49, if you want to get really wonky, is a very important technical level for 10-year Treasury yield. So we break that, the next big level is 4.7%, right? So if we break right where we are now, you could wind up seeing a pretty large kind of follow-on move, stops getting hit, and you could wind up seeing some more volatility in the rate market in a hurry.
Michael, saved actually 15 seconds for you. So now do we start thinking about the next earnings? And I was just going to pull up JP Morgan, dare I say, January 15th, earnings, the next focal point, just really quickly.
Yeah, absolutely. That'll once we get into the latter half of January, we'll start seeing the earnings come out, and that will be the bellwether. I think rates move higher from here, though.
All right, Michael Rosen, thank you so much, and of course our own Ira Jersey, guys. Thank you so much. All right, folks, we're heading over to our TV colleagues. Our simulcast, the closing bell, starts right now.
On the close.
Hey, you got me with...
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Alex Seal and Scarlett Fu taking you to the closing bell, a global simulcast. It starts right now. Carol Master and Tim Senevic in the radio booth as we welcome our audiences across all of our Bloomberg platforms here on a Fed day. 25 basis point cut. That was expected, Carol Master, but an update to that dot plot, taking a lot of folks off guard. You're seeing extreme moves right now in stocks, in bonds, and in the FX market.
Yeah, I mean, kind of across the board. I'm looking at something like housing stocks. They're down about 4% at this moment. Looking at bank stocks, they're down more than 4%. So, new narrative, reset, I don't know, but it definitely feels a little bit differently today.
The Russell 2000 is something I've been looking at closely because it's getting hit right now hard. It's down to levels last seen since before Election Day, so giving up all of those post-election results down to lowest since November 4th.
Yeah, I wonder how much of this selling will be sustained into tomorrow. We've been talking a lot about how, people were waiting for this as the last big event of 2024. Okay, it's come. How is this going to continue, or, starting tomorrow, everyone takes off?
Well, that's what I am curious about is, does this become that buy the dip moment, or are we kind of at the mercy of, I think what you're alluding to is just kind of seasonality. The idea that a lot of people are kind of moving away. A lot of people are going to book very large gains on this year, so why take any sort of unnecessary risk over the next, 4 to 5 weeks until the president's inaugurated?
On the other hand, though, like in theory, why wouldn't you buy the dip? I mean, if Jay Powell said anything, he said that the U.S. economy is really strong, and much stronger than the rest of the world. That's why they revised their growth target up, why they had to revise their inflation forecast up a little bit, and we still are coming with cuts, just not in January necessarily.
A lot of questions, though, as to exactly why this move would be so extreme. We talk about an S&P 500, more than 90% of the stocks in that index are in the red. Remember, the last time we saw this type of extreme sell-off was back in early August when that carry trade blew up, and before that, you have to go all the way back towards the beginning of the year when there was a lot of concerns about recession risk. We get the closing bells in New York with the Dow Jones Industrial Average down by 1,100 points or 2.6%. The S&P 500 closing back below 6,000, down 179 points or 3% lower. The NASDAQ Composite down 700 points or 3.5%. The NASDAQ 100 down about 3.6%. And the Russell 2000, 103 point drop today or 4.4%.
All right, so just going through those averages, folks, you've got 483 names in the S&P 500 lower, so almost all of them remain. You just mentioned this. And Scarlett, if you go over to the NASDAQ 100, you've got 100 names to the downside, 1 to the upside. So you are seeing really some broad-based selling as we speak.
Yeah, it's pretty clear that the appetite for risk is not there today. You look at the IMAP and red all around, including when you break down the sectors into 24 industry groups as well. Still, it's notable that your outperformers and that they didn't fall as much as the overall S&P 500 are healthcare, consumer staples, and utilities, classic defensive sectors. Worst performers, consumer discretionary, real estate investment trusts, each down by 4%, and communication services losing 3.1%.
And your superlative on the day, the S&P falling its biggest post-Fed drop since March of 2020.
Yeah, we've also got some earnings crossing the Bloomberg terminal. We should just quickly mention Micron, certainly one of the names in the semi space. First quarter adjusted revenue, $8.71 billion. That is spot in line with what Wall Street was expecting. First quarter adjusted EPS, $1.79 a share. That's 3 pennies better. And then going to the outlook, the company says it sees a return to growth in the second half of the fiscal year and sees second quarter adjusted revenue, Tim, of $7.7 billion to $8.1 billion. And that is below the estimate of $8.99 billion. Stock down.
Look at this.
Yeah, almost
shares
12%.
down in the after hours, 12%, as Carol mentioned. Micron saying that consumer-oriented markets are weaker in the near term. Second quarter adjusted revenue coming in 7.7 to 8.1 billion, missing estimates of close to $9 billion. That's perhaps why we're seeing shares down about 8.6%.
Yeah, there were some concerns that perhaps Micron would be a little bit cautious heading into these results. Certainly the thing everyone's going to be listening for in the conference call is anything that says about the high bandwidth memory products, which is really the driving force, the growth area in its business, because the DRAM sales, they're just kind of there. It's the legacy business, and there might be a little bit of a glut in that inventory.
Yeah, and it's kind of interesting, too. We talk about a company that is much more wedded to the consumer space relative to some of its peers. They have a much better mix in terms of what they're doing with enterprise customers, et cetera. And maybe that's why you're seeing their reaction. And then, of course, there's just the obvious, which is this is probably the wrong day to miss on it.
Yeah, no kidding. And just adding on to that, second quarter adjusted EPS, that outlook now between $1.33 and $1.53 a share. That estimate was for $1.92. So just to keep in mind that lowered outlook for the second quarter. Also, the vibe after last quarter from Micron was that the consumer part of its business was actually slowly going to improve. So this definitely a hit.
And I guess to your point, I don't know if it was you or Scarlett that made the point earlier about this idea of sort of what actually is the next catalyst. And you kind of forget, not only Micron, but you get FedEx, you get Nike, you get some pretty consequential companies reporting this week. And if they have misses, particularly if there are major misses here, are we going to see an additional sell-off here as people get concerned about the state of the market?
All right, also saying that it's the worst post-Fed day in 4 years. So, again, just giving a little bit of perspective.
Keep that in mind when you do your gainers. I'm just throwing that out there.
Be kind to me.
NVIDIA.
Are they all gainers today, Carol?
In case they're
it wasn't easy.
Red
it wasn't an easy task, and I waited till kind of after the Fed decision. So maybe I should just move along. NVIDIA was up 5%, and it was a top gainer winner
right, we'll
in
give
the
you this
NASDAQ
one.
100. Be kind,
It was a
be
wild.
kind. It's down about 1%. So it's been down, I know, 5 trading days in a row. Let's just move along. I'm just moving along. Here's something that you cannot dispute. Quantum Corporation. Yes, it's a microcap company. Yes, we did see a couple of trading halts today. The stock at its highs up 170%, finishing the day with 153% gain, $60 and change. It's about a $238 million market cap. At 19% of the float is shorted. It was out with a press release noting it's developed a new file system. It gets a little wonky and a little tech wonky, if you will, but it basically supports storage capability of NVIDIA. So I feel like tied to NVIDIA, you often get a little bit of a kick. And this one, really excited. It's actually for Alex, who I did not know had 2 pairs of Birkenstocks, but well, lo and behold, she does.
That's nothing compared to my like 16.
No, I know. But my Birkenstocks are not on brand for me. Like, this is not something I would normally think of when you look at, the heels that I normally wear.
All right, so up 11% at its highs, finishing the day, holding on to about a 2% gain here. The company reported fiscal fourth quarter revenue and earnings per share exceeded expectations, issued an annual outlook that analysts described as solid. It's, soaring in the last quarter, this company. So, and this is one of our standouts in today's session. So now over to Tim, who had a lot to choose from.
Yeah, the easy job today, especially when we started to hear from Jay Powell. I do want to start with shares of Tesla, which were down as much as 11% in the session today. They just started tumbling following Jay Powell's press conference. Finished the day down 8.3%, still up more than 80% since Election Day, guys. So we do have to look at this one still with a grain of salt. But some of that euphoria, some of that has been pulled away. Also, shares of Broadcom finishing the day down by 6.9% today, down for a second day in a row following Friday and a Monday's rally when shares moved higher by a whopping 38%. After yesterday's decline of 3%, it's down more than 10% from that all-time high that it did reach on Monday post-earnings. And finally, Sezzle, it's the buy now, pay later firm. It's about a $1.3 billion market cap out of Minneapolis. Shares just fell more than 20% after Hindenburg Research said in a post on X that it's short the company. A representative for Sezzle did not immediately respond to requests for comment. Shares falling 23% today.
All right, I'm going to the bond market, and then we'll get to some breaking news. The bond market had an incredible day. The sell-off across the board. It was the belly, though, that really felt the brunt of it. Those yields up by about 10, 11 basis points. So superlatives, there was a lot to choose from. The 2-year yield moving the most since of October. You also had the 10-year yield, the highest since May of 2024. You had a sell-off in the TLT. That's, of course, the ETF that tracks the 20-year. So it was very dramatic in terms of the slide that we saw within the bond market. We do have some breaking news, guys. I just wanted to point that out. Fox News says that Trump says he is against the stopgap bill. So.
Yeah, the stopgap bill.
This is a big deal. I mean, we're facing a deadline, on Friday, December 20th, whenever December 20th is. And we had heard rumblings earlier that at least congressional leaders, Republican leaders, were pushing back against this. And now, of course, the president-elect coming in here. I wonder if this is going to add to some of the pain. You're actually seeing futures in the post-market trade on the S&P now extending their declines by at least a half percentage point.
So I think this answers the question whether the sell-off will continue into tomorrow because of this headline. The idea that a government shutdown would be in play once again is not something that people have been pricing in at all.
I also think it also, Elon Musk, right, making comments earlier, and I think we were all questioning, like, does he speak for the president? Does that mean, this is kind of what's to come? And it just kind of says a lot about kind of Elon.
But it gets to this issue, too, of Jay Powell was asked repeatedly about how they're sort of factoring in some of these Trump policies, and of course he's not president yet, and so I can understand why he doesn't want to answer that. But to say we're just looking through it, or we're going to see through it, is like, what are you talking about?
Well, I think that he has to say that because, well, the president-elect is not president yet, and we don't know to what extent he's going to implement the policies that he's talked about at this point. Is he using sticks? Is he using carrots? Is he, is it all talk? What's going on here?
But also, like, when has the market moved, though, on funding issues, guys? Like, we've been dealing with this forever, and it was, what, 2012 was when we saw, no, went back. Where did we see the downgrade?
2011.
2011, thank you. So it was 2011. Like, that was the big moment, right?
Yeah.
But we've had these shutdowns all the time. Like, I can't believe that this is going to move the needle on that end.
No, but we've got a lot more debt out there, too.
But
I
think, isn't it sort of the broader, the kind of the totality of it all, though? Alex, like, I mean, the idea that it's not necessarily just this, but it's all of these sort of events kind of coming together.
Also, it's not just in the U.S., right? You look at what's happening in Brazil, you look at what's happening in Canada, you look at what's happening in Germany, what's happening in France. Like, all these G7 countries are dealing with fiscal issues and whether they can kind of sustain their spending.
Yeah.
Well, So much for a boring Wednesday.
All right, well, Merry Christmas, everyone.
Merry Christmas.
And Micron's getting hit. Like,
Move to cash and go
now?
home. All right, guys. Yeah, and Micron, as you said, Alex, still getting hammered, so we'll watch that into the Thursday trade. All right, guys, that's a wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. We'll see you again, same time, same place tomorrow for the closing bell.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
All right, everybody, as you know, we are all in on the Fed today. Bank stocks sensitive to monetary policy moves really getting hit in a big way. I'm looking at the KBW Bank Index falling down to its biggest one-day drop in 4 months. I'm just checking, is that the close? Down 4.3%?
Yeah, that's at the close, down 4.3% today.
Yeah, because it looks like it's continuing to drop, I think, in the aftermarket.
That's not surprising given what we heard from Trump just now, and also concerns maybe that the sell-off continues into tomorrow's session.
It's a really good point, right? I mean, just kind of layering more and more stuff. We should put out shares of the publicly held New Jersey-based Connect One Bancorp, which is the parent company of Connect One Bank. It too, not surprisingly, like a lot of other names, a lot of banking names, getting hit. Let me just pull up the close, down 7% in today's session. We should point out that the bank has $9.89 billion in assets, counts small businesses and construction companies among its customers. It's why we always love to check in with Frank Sorrentino. He is chairman and CEO of Connect One Bancorp, and he joins us from Englewood Cliffs, New Jersey. The company has about a $911 million market cap company. Frank, good to see you. What stands out for you today in today's Fed decision? Your stock, like most bank stocks, getting hammered, the whole market really across the board. Is there something ominous coming?
So great to be back with you, Carol and Tim. I find it always fascinating that good news brings negative markets, right? So a stronger economy and a place where people are doing well and strong employment and, you know, all the other things that define a more robust economy, and the market sells off. So certainly I don't think there was any surprise to today's Fed action. Interest rates being lowered by 25 basis points, some rhetoric around future cuts not being as much as the market wanted. And I think that's what really drove a lot of the sell-off today. And so there was a lot of enthusiasm and optimism, certainly in the banking system, about much lower interest rates. Well, that's not really going to happen. On the flip side, I think we're going to start to see potentially a steepening yield curve for banks. And so ultimately, I think it will be a good thing.
So one reason we like to talk to you, and I know Carol's got some questions about bank net interest margin and stuff, but I want to go right to your clients because one reason we love talking to you, and if people were paying attention to you, gosh, anytime in the last 2 years when you've been on our program, then they wouldn't be surprised at how good the economy has been over the last couple of years, because you repeatedly were beating that drum saying the companies that are lending with us, the companies that are our customers, the small businesses, the construction companies, they are doing well right now. How are they doing compared to over the last 2 years for you?
Look, I think I've said this before. You know, what we are seeing today, we are still in quite a robust economy. The vast majority of our clients are reporting good news. Is there some normalization going on within the economy today? You know, from all the post-COVID, the monetary policy, the expansion of the Fed balance sheet, liquidity in the system? Sure. Is that all beginning to normalize and we're getting to a more consistent with historical norms relative to interest rates and growth rates and everything else? Yes, that's happening. Is anyone really saying that the economy is weak today? I don't see it. Our clients are still saying it is difficult to hire staff today. People are demanding more money. Supplies cost more. There is a little bit of inflation still within the economy. But certain things are beginning to level off. Rents are beginning to level off a bit. Potentially housing prices are reaching a point where they're becoming, I don't want to say unaffordable, but they're certainly reaching the edge of people's affordability spectrum. Interest rates are playing a role there. There's been a lot of desire to see interest rates come down a bit. I don't think it's going to happen. I think we are in a very strong cycle, and I think it's going to continue. Certainly, if you think about everything that we're talking about doing in this next next administration, these things all have some inflationary component. So we are going to see a strong economy in my opinion, as far as the eye can see.
So, Frank, then why did the Fed cut rates? Which is kind of the question I think our Mike McKee asked. Like, I feel like this is the 5-year-old to Jay Powell. Why? So why? So why? Why cut rates if the economy is robust, like you say?
Look, I think the data that the Fed was looking at, they're looking in longer term, segments of time, and they have what they want to get to, which is a neutral rate. And I think this is part of their program to get there. I don't serve on the Fed, so I don't know for sure. I don't know exactly what data they're looking at. But clearly they're seeing signs that they can get to a certain point in the interest rate curve on the short end that meets with the program that they believe brings us full employment, low inflation, and gets the economy to continue to move on. You have to say they've done a pretty good job up until now. I don't know that anybody should have been surprised by today's action, but I understand the point, like why lower rates, but I don't think it's a month by month, decision. I think these are decisions that they make with a bigger period of time in mind.
Well, people clearly surprised given the equity market reaction and the bond market reaction. Hey, one thing we wanted you to weigh in on is the political environment, which we know that CEOs don't love to do, but this is the world we live in. We just learned that President-elect Donald Trump said he is opposed to the proposed short-term government funding bill that has just been floated by Congress. This is according to Fox News, who cited a conversation with Trump. What does that mean to you? And what does the another 4 years of Donald Trump mean to you, given what we learned about him 2017 to 2021? How are you preparing for it?
Well, look, I think I try to look at the economy. I try to look at our clients. I try to look at how these things are going to impact them. And the only thing that concerns me about things like we heard today is creating a level of uncertainty. And, the one thing that business and the economy really wants is certainty. They want to understand where things are headed, how can they make plans, and how can they go about running their lives, running their businesses. And whenever there's any level of uncertainty and, talking about the federal budget and whether we're going to fund it or not, and whether people are going to get paid, government employees, that creates uncertainty, and that's generally just not good.
Hey, just got about a minute left. So how frustrating is that for you? You've got to make decisions. I mean, you guys expanded your reach. Last time we talked with you in September, we talked about that. So you're growing. But I mean, how hesitant are you to do things because you're not quite sure of the policy that's going to come from this White House? And got about 30, 40 seconds.
You know what, whether it's this administration or any other administration, I look at, what's going on the ground, and I am very bullish about what I see, certainly in our market area, certainly around what we're doing here as a nation. We are the greatest nation on the planet. We live in one of the greatest parts of the nation. I'm very bullish about our economy, and so I make those decisions, and we all here at Connect One make those decisions based on what our clients are telling us and what their needs are. And so we feel pretty good about where things have been. As you said, I've been saying the same thing for the last couple of years, and where things are going.
Are you as robust in your outlook as you were 3 months ago prior to the election? And again, just got about 10 seconds.
I think we will see some winners and losers as we move forward.
Okay.
And it may be slightly less robust, but robust nonetheless.
All right, good stuff as always. Frank Sorrentino, Chairman, CEO at Connect One Bancorp. All right, coming up, we're going to talk about fair pay with someone who has something to say about that.
It's 4:21 on Wall Street. We do check markets all day long. Here at Bloomberg Fed Wednesday, steep losses for the U.S. equity market with the S&P down 3% in the biggest post-Fed drop since March of 2020. Reaction to the Federal Reserve and the sell-off from Frank Sorrentino, the chairman and CEO of ConnectOne Bancorp, who was interviewed moments ago right here on Bloomberg Business Week.
I don't know that anybody should have been surprised by today's action, but I understand the point, like why lower rates, but I don't think it's a month-by-month, decision. I think these are decisions that they make with a bigger period of time in mind.
Frank Sorrentino of ConnectOne Bancorp. So today we had the Federal Reserve lowering rates by a quarter point as expected, but it reduced its forecast for cuts next year. The S&P dropped 178 points today, down 3%. The Dow was down 1,123 points, a drop of 2.6%. Nasdaq down 3.6%. 10-year right at 4.50%, with the 2-year 4.34%. Gold down 2%, 25.92 the ounce. West Texas Intermediate crude, $70.12 a barrel, little changed, up 0.1%. Bitcoin now down 5.1% at $101,000. After the bell, Micron Technology plunged. The largest U.S. maker of computer memory chips gave a weak sales forecast for the current quarter. Also, one other story, President-elect Donald Trump says he is opposed to the proposed short-term government funding bill that has just been floated by Congress, that according to Fox News, citing a conversation with Trump. Again, recapping steep losses for the U.S. equity market. S&P down 178 today, down 3%. The 10-year, 4.49%. The 2-year, 4.34%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie. Do appreciate it. Hey, worth recapping a little bit about what led to that sell-off that we saw late in the session today. Federal Reserve officials lowering their benchmark interest rate for a third consecutive time, but they reined in the number of cuts they expect in 2025. It signals greater caution over how quickly they can continue reducing borrowing costs. Powell also added that interest rates were still, quote, meaningfully restraining economic activity, and the Fed is on track to continue to cut. But he said, Carol, officials would have to see more progress on inflation before making additional rate cuts.
Heard that before from the Fed chair. U.S. stocks declining, bond yields surging after that Fed move. The S&P 500 falling below 6,000, suffering its worst day since August. The Nasdaq 100 dropped 3.6%, the most in 5 months. And then if you look at the 2-year note, most sensitive to what the Fed does, it surged 10 basis points to 4.35. 10-year rate rose to a level last seen in May. Bloomberg's gauge of the dollar jumped to its highest since November of 2022, and as we said, S&P 500, its biggest post-Fed drop since March of 2020. Gotta say, it feels like a little bit of a new narrative, but it'll be interesting to see what the trade is tomorrow, so it'll make Thursday even more interesting.
Yeah, Bailey Lipschultz is going to be swinging by, senior equities reporter, going to give us a view on equities. I should note, too, Micron shares down about 12.5% after a sluggish PC and phone demand hurts its forecast.
All right, we want to get to something that's certainly near and dear to us. I think about our conversation with Peter Atwater over at William & Mary, the K-shaped recovery. We talk about records that we've seen in the market, gains for a lot of Americans, and yet that's not the case for everyone. The gap between also, and this is kind of an extreme measure, how much execs make versus how much those on the front line of the companies make is something we talk about a lot. Check this out. According to the Economic Policy Institute, CEO compensation rose by more than 1,000% between 1978 and 2023, while the typical worker's compensation, Tim, rose only about 24%.
Here's another way to look at that gap. Last year, CEOs made 290 times as much as the typical worker. This is coming from the Economic Policy Institute. Back in 1965, it was only 21 times as much as the typical worker. So it may be surprising to you, not to our next guest, who says we need to, quote, pay the people. John Driscoll is the former CEO at CareCentrix. It was bought by Walgreens Boots Alliance more than 2 years ago. He's currently senior advisor at Walgreens Boots Alliance. He's had several senior executive positions at a variety of healthcare companies. He's also a member of Patriotic Millionaires, which calls itself a collection of wealthy Americans fighting against the destabilizing concentration of wealth and power in the United States.
I have to tell you, we have about an hour's worth of questions that we want to talk to you about, just because there's so much going on in healthcare, as you know, right now. But let's talk wages and the gaps and how we fix this. I mentioned Peter Atwater, the K-shaped recovery. Some people are doing really well. There's a lot of Americans who are not, and whether that plays out in politics and so many different aspects of our society, why is it that we continue to see people who don't make a living wage?
Well, Carol, I think we've lost the string. You know, I actually am no longer working at Walgreens and focusing on healthcare. I'm really focusing on making the case that it's good for business and it's good for America if we can get to a living wage. You know, we lost the string a while ago between the 1930s and 1980. Median productivity in the United States went up by about 97%, and the median wages went up by about 90%. Since 1980 to today, productivity's gone up another 90%, but median wages have only gone up by 9%.
That's a gap.
It's inconceivable that we should sort of push working class folks farther and farther away from being able to take part in this great capitalist adventure that's working for so many of us. But you know, there's 40 million people in America who aren't earning a living wage.
Do you think the incentives are misaligned? Because if we think about, and you've been part of publicly traded companies before, what do investors care about? They care about the top line, and they care about the bottom line.
We never talk about, okay, so they'll, you know,
Oh,
wages,
how much?
Yeah, how much did, you know, the people on the front lines make?
You know what they care? They care about automation and increasing margins.
Yeah.
But I think, though, that you're starting to see things change. You know, at my own
We
company,
thought this 2018 with the economic roundtable, and it's only gotten worse.
I think that first of all, the trend's been horrible for the last 30 years, as I just pointed out. But at my own company, when we froze executive salaries and doubled minimum wage 12 years ago, retention went up, engagement went up, but productivity also went up by about 30%. And you're starting to see some of the most successful companies in America, Bank of America, JP Morgan, also raise their wages to a living wage. They did it as part of that business roundtable commitment, but what they found is that it lowered the number of people who were leaving their jobs, because people who are working in minimum wage jobs are often working 2 jobs. They're not as engaged. They found that productivity went up. What they invested in kind of if you want a fairer social contract, they found they had a more successful and profitable business. I think the most important thing is we get the story out that it is a productivity gain and a win for the companies, and also that I don't think that capitalism can easily be sustained if the bottom third of the workforce isn't really part of if the company wins, you win.
So why don't we do it then? Like, you lay out a really good premise, an argument. Why isn't it that more companies don't do that?
Well, that's what I am focused right now, Carol, on selling that story and telling that story. Because even for the executives that have done it, they are surprised at how it increases how long folks stay at jobs. It increases their productivity. But that's not a story that many people have told, and they certainly haven't told it with very specific examples. You know, our ability to pay claims grew by 30%. People stayed at our company for longer. We had fewer people quietly quitting or quitting very quickly. And so I think it's selling and telling that story. I also think that we're getting the message in a lot of different ways. I think the reason why we have so much rancor, anger, and discontentment in working class voters of all races and backgrounds is they're not really feeling like they're part of business, of an America that works, where business is clearly working and being successful.
Because, John, you know, one of the things Tim and I have talked about a lot, and you write about the restaurant association and the restaurant industry, that I feel like, first of all, we feel like there's a tip jar everywhere, and to me it just says we're not paying workers enough.
Correct.
And why aren't companies paying workers? Why do I would rather pay more for an item and just ensure that these workers are getting paid. I think about the restaurant industry that, you know, right, they expect that they're going to be tips. Like, how do we kind of rework that?
Well, I think we have to actually tell the story, and then organize. But there are plenty of examples. Danny Meyer has been a leader and a supporter of the movement that we're working on, which is to eliminate kind of the tipped minimum wage,
right,
which is still at $3.25.
It's unbelievable.
And you start thinking if we're not talking about Danielle, we're talking about most people are working at Denny's, and when you increase the minimum wage and you get to a fair wage. You know, California raised the fast food minimum wage to $20 an hour. I thought it was an odd thing to do, but there was a lot of complaints that would harm the industry. There's thousands more fast food jobs now.
Why did you think it was an odd thing to do?
Well, I think it was odd to just bring it up for one category. For me, the most important thing is to eliminate tip minimum wage across the board and get to a living wage. Again, you've got 40 million people where they're working full-time jobs, and one job doesn't afford them enough to live independently and pay their bills.
What do you think of the most wealthy people in the world right now? Someone like Elon Musk, for example, whose fortune has increased by roughly $200 billion just since the election. Certainly took a haircut today with the sell-off in Tesla. What do you make of the concentration of wealth at the very top?
Well, I think one of the things that we actually got me excited about Patriotic Millionaires is that I was deeply offended by the notion of the reduction of taxes on the most wealthy and the reduction of the estate tax, because I think the threat of intergenerational oligarchic wealth of massive scale, intentionally or unintentionally distorting the politics of the moment, is a real challenge. And that was 20 years ago when I started working with Patriotic Millionaires. But I don't think the biggest problem we have is the massive accumulation at the top, because part of that's related to technology. It's the fact that we cut off the bottom third of workers in America, and that's not going to be good for the economy. If more and more people feel like they're not part of the American dream, we're the only country that dream is associated with the country. Our country is held together by this notion that we're in it together. If the bottom third of America does, from a wages and wealth perspective, doesn't feel like they're part of it, I worry about democracy. I think there are plenty of things you could do in tax policy to certainly make sure that, as Warren Buffett says, he isn't paying a lower percentage of taxes than his assistant. I think we should have a fair inheritance tax so we don't have these massive concentrations of wealth. But the urgent problem of today is to pay people who are working hard, leaning in, people who are at the bottom third of the wage scale, who are really, running up a down escalator of costs, particularly at a time of inflation.
So how do we get executives to start thinking about it? We have many conversations with CEOs, and we often do hear about having to pay up for talent, but I'm assuming they mean executives and folks kind of higher up in their company, and not necessarily everyone. How do we get them to think about that all across all of the workers that they pay for?
Well, I don't know how we convince them, but the voters are already there. The raising the minimum wage to a higher level has won in almost, I think it's 19 out of 20 states that's been put on the ballot. In the last election cycle, raising the minimum wage won by 6 points in Missouri. It won easily in Alaska. Those are both Trump plus 10 or 20 states. And the Republican attempt to reduce the raising the tip minimum wage actually was defeated at the ballot box in Arizona. So the voters are already there. I think the only way we're going to get there today is politically, because if you have to convince one executive at a time, we'll be here forever.
So through voters?
We have to put it on the ballot. We have to get it through Congress. And I think what's remarkable to me is the Republican voters are already there.
Yeah.
Is it a zero-sum game? Like, is it if to pay workers more, do executives have to earn less?
Not at all. I mean, the most recent example of raising fast food minimum wage and creating more fast food jobs is the example of the last couple of years. But when the Restaurant Association, as we talk about in the book, actually polled its members, not its lobbyists in D.C., they found that many of them actually wanted to increase those wages. There's a Nobel Prize-winning economist who studied what happened when New York raised its wages in hospitality and Pennsylvania didn't. And what they found is that the New York businesses actually grew faster, which means those business owners made more money even though the wages that they had to pay were higher.
Well, do you think raising minimum wage in one sector, like restaurants, does raise minimum wage across other sectors too? You don't think so? So you don't think, like, if you're getting paid $20 an hour to work at McDonald's, then the warehouse owner has to raise their wages to that, or else their employees are going to go work at McDonald's
I
instead.
mean, is the burger going to go up or the fries going to go up?
Well, the reality is the percentage of labor that goes into the Big Mac is actually pretty trivial. It would probably, to pay a living wage at McDonald's, it would probably go by 4 to 5 cents per burger. So I think it's
not much.
It's de minimis.
I'm playing a little bit devil's advocate here.
No, absolutely. And where I was going with is we're moving too slowly. It's time to actually change the laws, change the rules, and make sure that everybody at the bottom end of the pay scale is paid a living wage. And that's true for folks. We've got to eliminate the tip minimum wage. I would eliminate the discount for disabled workers. We have to get to the point where all executives who believe in the dignity of work start paying wages that are equivalent to dignified pay.
We have this terminal function on the Bloomberg terminal where we can look up executive compensation. So forgive me for being fresh, but you are part of a group that does argue that many people should be getting paid more and executives sometimes should be getting paid less. In 2023, your total compensation was over $11 million. Was that too much? Were you paid too much?
I have been the beneficiary of a capitalist system that overpays the top and isn't paying enough at the bottom. But I am absolutely certain, that we could get to a living wage level, and it would make no big dent on the comp at the top. But let me also say that as a patriotic millionaire, I am on the record as saying I think we should increase taxes on people like me and increase the estate tax for all of us.
How high should they be? Because if you go back in history, I mean, the top marginal tax rate would shock, 50, 60 years ago, would shock people today.
Yeah.
I mean, it was like
insanely high.
Yeah. It was insanely high.
Let's start by not extending the tax cuts that Trump put in place when he was in office. Let's start by getting to a level that we were paying during the Clinton administration, which was one of the greatest periods of prosperity, and we were actually paying down the debt. We have a $1.7 trillion deficit this year. It is not going to be news to anyone who can do math that all of us are going to be paying taxes, and I think it should be very clear that people like me should be paying more taxes than most.
Yeah, but we've been hearing this for a couple of years. I mean, I remember being out at Milken a few years ago and people saying, yep, it's time for us to pay more taxes, really wealthy individuals, and yet here we are. One thing I want to ask you, because we're running out of time, is that if we believe in a free market, I'm looking at your book about some of the myths that are out there, that if we pay people a living wage, some of the myths that you kind of address. And one is, this isn't an issue for the government because the free market will naturally take care of it. We saw wages go up during the pandemic and out of it because there was a shortage of workers. And so supply, demand, free market, it was at work. But I don't know that will continue. Will the free market kind of help bring this about?
Well, I think if you look at where wages are right now, even during the pandemic, while there was a slight bump in wages at the bottom, costs went up at twice the rate that wages went up.
Right.
And so, no, the free market has failed. And by the way, it worked when we actually had a minimum wage that was closer to reflecting a living wage, which drove the greatest period of economic success the world has ever seen between the 40s and the 80s. We unhooked the bottom third of the workforce at that point, and I think we've got a pretty angry, unhappy electorate and a lot of people living in near poverty, and that's just not fair.
We just had a conversation with, what was it, the CEO of Feeding America?
Feeding America, yeah.
And just talked about, the people who just don't have enough food on their table.
Yeah, food insecurity in this country.
Food insecurity.
It's just mind-boggling.
Just incredible, the percentages. And so we see
one out of 3 or 4 kids, 1 out of 5 households. That is unacceptable. And by the way, paying a living wage is not going to cost capitalism. It's actually going to improve our markets and business environment.
30 seconds is a living wage the same in every state, in every city? It's got to be depending on the locale.
No, I think that the feds should set a living wage at the national median.
Okay.
And then you can vary it up or down based on what the true cost. The costs in LA and New York are very different than the costs in Jackson, Mississippi, or West Texas. You have to vary it. But the minimum is so low right now as to be insulting to workers.
I feel like you're preaching to the choir. John Driscoll, come back soon. This was an important conversation. Of course, former CEO of CareCentric, his new book, Pay the People, Why Fair Pay is Good for Business and Great for America.
Hey, a couple headlines here crossing the Bloomberg terminal. Trump and Vance say that Congress should debate the debt limit now. Here's what they said in a statement posted at 2X. Quote, increasing the debt ceiling is not great, but we'd rather do it on Biden's watch, President-elect Trump and Vice President-elect Vance said in a joint statement. If Democrats won't cooperate on the debt ceiling now, what makes anyone think they would do it in June during our administration? Let's have the debate now.
Yeah, again, in a statement, Trump-Vance also called for Congress to, quote, pass a streamlined spending bill that doesn't give Chuck Schumer and the Democrats everything they want. So something that we are continuing to watch on a very busy Wednesday afternoon. Having said that, let's get back to the Fed decision and the market trade, because we did get, as expected, the Fed cutting rates again by 1/4 point, but again, reducing expectations for the new year. And we did see quite a market sell-off. As we've said, the S&P 500 falling 3%, the biggest post-Fed drop since March of 2020, so in a long time.
We got with us Bloomberg News equities reporter Bailey Lipschultz, senior equities reporter. Did I hear that earlier today?
Yeah, depending on the person. Sometimes
I was
they
listening
give
to
me
Bloomberg
credit.
Radio, and I said to myself, Bailey Lipschultz, congratulations,
Oops,
senior equity reporter.
Congratulations.
Who made that decision?
Well, hey, senior, you got to deal with this market trade today. How do you make
This is
sense
why you
of
get
this?
paid the big bucks now, Bailey.
A lot of uncertainty, a lot of questions now coming back into what does Donald Trump back in the White House actually mean for the economy? What does that mean for inflation? How can the Fed actually approach cutting? Because if you look at what Jerome Powell said was essentially, until we get inflation under control, I don't feel comfortable doing another rate cut. We have had basically 1 percentage point of interest rate cuts in the last few months, and things aren't as strong as we would need for us to continue to lower interest rates.
So looking at today's trade and the way that we saw stocks fall, really since Jay Powell started speaking today, I mean, that's what happened. What are your sources saying, the folks you talk to, the notes that are coming out now? Do they say this is, hey, just a post-Fed surprise, sell-off, this is sort of a blip? This is not part of something bigger as we head into the end of the year?
I think it's a mixed bag. I've seen and heard from some people who are saying we've seen bad breadth. We've seen only a few companies holding the market higher. We've seen big tech being the kind of final bastion holding the market near record highs. There was a sell-off kind of in the making. It was a question of what would trigger that. Would it be closer to the inauguration? Would it be after Trump starts potentially signing executive orders? Well, we got the answer today. The big question is going forward, how is the market going to position? Are we going to see people forced out of some of their positions? Are we going to see margin calls happening? Or are we going to see people buy the dip? We've seen a number of sell-offs happen, and then investors find cash on the sidelines and quickly put it to work.
Yeah, I don't know. It's kind of, interesting. Here we are, how many days? 13 days, wrapping up 2024. You do wonder, it's still been a very strong year for anybody in the equity markets, certainly if you bought the index. And I'm just wondering, do we just kind of have to be in a bit of a wait and see what comes out of the administration? Or I don't know. We just talked to the head of Connect One Bancorp, Frank Sorrentino, and he continues to use the word robust to describe the economy. He's been talking about this for a year, and he hasn't been wrong. So I just wonder, I don't know. I guess we go back to fundamentals, economic fundamentals, earnings fundamentals. Like, is this just a little bit overbought, valuations high, or something more problematic?
I don't know that there are a ton of issues, as you mentioned. When you look at the returns year to date, you have over the last 12 months, S&P returning 26%, NASDAQ 100 returning 28%, even the Russell 2000 returning about 14%. So this isn't a bear market. This is potentially, to your point, maybe investors rounding out their portfolios. But when we do keep an eye on earnings, and one name that I imagine you guys discussed was Micron. This is a bad print from a big company.
Yeah,
right
what
now
a
it's
day
down
to have it
12%.
too.
Exactly, and they only fell, only in quotes, but they only fell a little over 4%. But when you look at a 12% move down on a stock that's pretty critical in terms of chip making, pretty critical in terms of kind of the broader technology ecosystem, it's a $115 billion market cap.
Did we learn something new from Micron that we didn't know about the market? I mean, our own Ian King writing, Micron Technology tumbling in late trading after its revenue forecast missed projections by about $1 billion, hurt by sluggish demand for smartphones and PCs. We knew this. We knew this. We knew there was sluggish demand in PCs.
Yeah.
We knew there was sluggish demand for smartphones.
But I think when you think about what goes into a sell side analyst's model and what are they actually predicting, they're talking to companies, they're talking to the management, they're in their ear of the CEO. So there's a reason that you can beat expectations. You're lowering your forecast kind of in line with what you're getting directionally from management. When you go out and you have an earnings print where when you look at second quarter adjusted revenue forecast, your midpoint is about $1 billion, to Ian's point, below what they were penciling in. Yeah. That's a large miss, and that's not too far off. 2Q is not forecasting 2027 demand. That's a big miss in the immediate term.
So I don't know. How are you thinking about? We've got 2 more days left in today's trading session. I mean, trading week, excuse me. And then of course we go into kind of our holiday weeks, and I expect volume's going to pull back and so on and so forth. And I think it's safe to say some customers are, investors are going to be like, I'm done, I'm out, I'm good. Like, let's just see what the new year brings. But how are you thinking about the trade over the next couple of days?
The thing that I will be keeping a close eye on is, can the S&P 500 reclaim its 50-day moving average? We saw that service support back in November. It broke below it really meaningfully for the first time if you go back to early September. So it's been quite some time. So if we see kind of technicals deteriorating and we see some more actual real selling, that's when you have maybe some of that consternation of, okay, is this real?
But it's so interesting because it's so quickly you can go from a narrative, from overbought to oversold. And I'm looking at RSI right now. We're definitely now easily off the overbought. But how often does it move and then people are like, okay, this is a buying opportunity?
Well, I think that's been one of the things we've been keeping an eye on when we kind of came into Fed Day. You're looking at a market at or near all-time highs. And when you look at the divide, though, that we've seen between the S&P 500 and the equal weighted index, or we've seen the pullback in the Russell 2000 small caps, there's something going on under the surface where investors aren't as optimistic. It's maybe those 7 names or maybe even 12 names.
It makes me think about the B of A call that we were talking about, was it yesterday, right? Where they said, kind of investors are all in, pushing cash, and to them they said, okay, contrarian or whatever. Reading that as when everybody gets, I always think that too, right? We all do. When things get so upbeat, you're like, okay,
B of A, the B of A
something's going to happen. Where's the VIX today?
VIX popped above, I think, right around 28, which is 27.6. So moving really from 16 to 28 is a pretty sharp move. As someone who a lot of my day is talking to new issuance, so IPOs and people selling down stock.
That's a big bump.
You want it below 20. Yeah. We had really, for all intents and purposes, been below 20 for over a year.
I don't know. I do think, though, does this get some of the froth out of the market? Certainly for some of the names that really ran up. I don't know. I mean, I'm going to be very curious about all the commentary about Jay Powell as people kind of sit over it, stew over it, read some more, get some analysis of how they see it. He was optimistic about economic growth. That's a good thing.
Well, and I think that comes back to the point of, is the economy the market? No. And is a market that's hitting record highs where really fundamental strategists, other than we should be going higher and the vibes are high, there wasn't really a big driver in the last few weeks that you can point to.
Hey, before we let you go, Bailey, the Trump factor here. Trump says Congress should debate the debt limit now. This happening in the after hours as well. How are investors that you talk to thinking about the Trump presidency and sort of uncertainty around this? That's what Frank Sorrentino told us, is that the uncertainty around stuff like this can be a challenge. He's CEO at Connect One.
Yeah.
Yeah, the investors and bankers I talk to, the consensus seems to be more of a wait and see, because to one point, we have seen a Trump administration. We have seen how he handles D.C., but the other side is, will we see come January 20th and 21st, that first business day after, a bunch of executive orders being signed? Will he kind of come out, and how will he prioritize the things he wants to get done? Because that can also not only impact companies, but the economy and certain industries and subsectors as well.
What a day.
That's why they call him senior equities reporter.
Do you feel like, did you age a little bit?
I aged a little bit today, yeah, definitely did.
Bailey Lipschultz, thank you so much. You're listening and watching Bloomberg Business Week.
Catch complete coverage from the world of politics and the world of business on Bloomberg Balance of Power. Tune in for Joe Matthew and Kaylee Lyons tonight at 5 p.m. Wall Street time on Bloomberg Radio and television.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio and Television.
It is Bloomberg Business Week. Salesforce shares fell 3.8%. To be fair, pretty much everything was down today. The software company, though, introduced an update to its AI agent platform. Mark Benioff is the co-founder and CEO of Salesforce. He also owns Time Magazine. And he says that Agentforce 2 is the most exciting tech he's worked on, calling it an incredible moment with more than 1,000 contracts. He spoke to Bloomberg TV's Anne-Marie Herdern in an interview, and they covered it all, including Time Magazine's decision to name President-elect Trump Person of the Year.
Well, this is the most exciting thing I've ever worked on, really, in my entire career, which is the idea that humans with agents are driving customer success together. Now, we started talking about this at our Dreamforce conference a couple of months ago. Now, our Salesforce, our COO, Brian, just told me in the event that we've signed more than 1,000 contracts with customers to deploy. But probably the most exciting deployment, Anne-Marie, is that Salesforce has this up and running for our customers. Help.salesforce.com is live on Agentforce as of today. And so we have thousands of agents working with thousands of customers, working in hand with thousands of our human support agents, resolving customer success. And we've dramatically reduced the number of cases that we have to escalate to humans. It's an incredible moment.
So you have also a number of customers in vastly different industries using this technology. Adecco versus Saks. How are they each adapting it to their business use case?
Well, you're right. I think companies in every single industry have started to deploy this technology because, look, the human workforce is quite stagnant and everybody wants growth. So by providing digital labor, we're able to grow these companies in entirely new ways. This is a big thought, and you're right. Saks or a company like Adecco or Disney or Wiley or RBC Bank, all of these companies have the ability now to augment their employees, their human employees, with digital workers. And this is an incredible moment where we can begin to see a partnership between human labor and digital labor. It's going to deliver a much lower cost, much easier to use, and also much higher levels of accuracy and very low hallucinogens in the AI layer.
You said in a recent piece in Time Magazine that, quote, technology itself is neither good nor bad. What matters is how we use it. You obviously know all the concerns around AI, how it could displace workers. Obviously, it'd be very efficient, but it could displace workers to even maybe aiding adversaries, more nefarious actions. How do you envision regulators, Washington, policymakers, making sure that it is used for good, in good use cases?
Well, you're right. Technology's never been good or bad. It's how you use the technology that matters. And this isn't the first time a technology tool has made human beings more productive. but it is one that does seem to really dramatically impact human productivity almost immediately. You can see in the third quarter, GDP grew, but the human workforce did not grow. And economists are saying that the dramatic advancements in the last 2 years in AI have given us all just a little bit more productivity, and it showed up in the third quarter GDP. That idea that we can start to use agents and AI to extend our workforces with not just human workers, but also digital workers, this is an incredible opportunity. And yes, you're right. There's going to have to be guardrails, and that's built into our platform so that you as an employer, you have to build the trust into the agent because that agent is working with your customer. And all of those aspects of that interaction are going to have to be governed. And that's also built directly into our platform.
I know the Trump administration, incoming administration, thinking about this. The Biden administration was also thinking about this. They had a task force. Time recently named Trump Person of the Year. Have you spoken or met yet with the president-elect?
Well, I think you know that when I bought Time Magazine, I said that I wouldn't endorse any political candidate, and I stopped all funding of all political candidates. But I think you also know that this week, Time Magazine did say that President Trump is our Person of the Year, and I couldn't be more excited about that. I mean, everything you've seen from the story, from the cover to the story itself, it's the biggest story we've ever done in the history of Time. And this really speaks to a moment, I believe, in the political landscape where we really have to have a beginner's mind that every possibility is ahead of us. And I think it's only in the expert's mind that we realize that we might have the constraints that we need to kind of put aside. So I'm excited for the future. I hope that agents and AI are a critical part of achieving the next level of efficiency and capability inside not only our government, but every government. And I believe very strongly that we need to use these kinds of technologies to achieve a balanced budget, which I think is a bipartisan issue that all of us can agree on.
That was Mark Benioff of Salesforce. He is the CEO, the co-founder, and of course also the chairman of the firm. Also owns Time Magazine, weighing in there at the end about the Person of the Year.
All right, good to know. Hey folks, Tim, as we like to do at the end of our broadcast, looking at the most read stories on the Bloomberg. First one has to do with